Welcome to the virtual Eric Miscoll Show. I'm Eric Miscoll with EMS Now, and thanks for joining us today. As always, I'd like to welcome my co-host, Philip Stoten, joining us bright and early from Australia today. The focus of our discussion today is the M&A industry in the EMS, the M&A activity in the EMS industry, which seems to have been surprisingly robust here at the end of the year and with a lot of things going on. So to help us in this discussion and provide some insights, we've invited a few colleagues who are experts in this particular area. So joining us today are Tom Kastner, the president of GP Ventures based in North America, and Jan Poerschmann with Proventis, who's the managing partner of Proventis Partners, joining us from Europe. Gentlemen, welcome. Thank you for taking the time to join us today. I'd like to start by asking each of you to introduce yourselves and your firms for the benefit of our audience. And Tom, why don't we begin with you, sir?
All right, thank you. Glad to be a participant. My name is Tom Kastner with GP Ventures, and we are based in Chicago. We have 5 people total, so we're a boutique investment bank, but 4 people here in Chicago and 1 in Tokyo. We are specialized in tech and electronics with a particular specialty in both EMS, PCB assembly, as well as bare boards. And we've completed over 10 deals in both sectors. And our deal sizes that we work on tend to be kind of 5 to 100 million in deal size or so. And we work with both both on sell side assignments and with buyers.
Okay, excellent. Well, thank you for that. And Jan, if you would do the same, please, sir.
Sure, my pleasure. Thank you, gentlemen, for having me. My name is Jan Poerschmann. I have started Proventis Partners exactly 20 years ago. So that is the legacy that I bring to the table. We have grown that company now to a total of 30 professionals. We're based I'm personally based out of Munich. We entertain 4 offices in German-speaking Europe, from north to south. That is Hamburg, Cologne, Munich, and Zurich in Switzerland. In total, as I said, 30 people. We have done a little more than 300 deals, a little more than 10 billion in transaction value over the last years. I'm personally responsible for the TMT transaction team within Proventis Partners, which is a group of 6 professionals doing that type of transactions. Deal size, we're equally in the size-wise as Tom just mentioned. So anywhere between, we typically range up from 10 to 150 million. And I've personally been sitting on a board of an EMS company for about 6 years when one of their investors, a PE firm, asked me to help them with their succession. And I was running them through this succession. And if we like to, without getting into all the details, I can at least tell some of the experiences we made in completing that succession, which is right now done. And I'll keep the story how it ended for later.
Very well. Thank you for that. So let's just maybe look back before looking forward. And I'd like to begin kind of just asking, how was the M&A market for EMS in 2020, the year of the pandemic, right? But yet we saw some deals being done, which I thought somewhat surprising. So Tom, why don't we begin with you, sir? How would you characterize last year?
Oh, sure. Well, I think, we recorded or were aware of about 24 deals in North America in the the general PCB assembly EMS sector. So that's excluding, say, wire harness or cable assembly and so on. And actually, I think it would have been fairly higher if it weren't for the pandemic. Things did kind of grind to a halt sort of mid-March until the end of June or so. But then they really picked up after that. And so, I think, and of course, we don't hear about all the deals. So there's probably 10 or 15 that were relatively smaller that we didn't hear about. So, on the one hand, it was very robust. That's about the average number of deals in North America for the past few years is, 20 to 25 or so. But I think it would have been much higher if it weren't for the whole COVID thing.
Right.
Yeah. Tom, do you think there were deals because of the COVID thing, as well as did happen because of the COVID thing?
Well, actually, we did not see too many distressed deals. Only a few. So we actually participated in one on behalf of a buyer, but otherwise, we were anticipating more. I think, something, and I know all countries have some level of support, but in the U.S. we had, the PPP program, a lot of other loans and other programs. And I think obviously that was a huge help to a lot of companies, but it probably kept a lot open that otherwise would have sold or done something. So on the one hand, it may have helped buyers do more deals, but it probably kept more sellers on the sidelines. So which is great for them. Glad that they're able to survive. But just from a pure number of deals perspective, it probably dampened the number of distressed deals.
Does that create a precipice going forward when some of that support is withdrawn by government?
Well, that support continues. We've got program upon program. And, I think there are some great tailwinds going into 2021. But I do think eventually, whether it's, okay, we've survived this far, but it's just not getting better, or the support will eventually tail off. But more than that, I think most of the deals we see are, positive. There's positive, at least positive earnings, maybe not so much revenue growth, but on the behalf of the sellers. But most of the deals we see are positive for both parties.
Yeah, which is what you want.
Jan, tell us about Europe. How was 2020?
Well, total numbers, pretty likewise. There were, I think, close to 30 pure play EMS transactions all over Europe, counting all continental Europe and the UK. And then in Germany, we just had 6. What I noticed is we had a sort of an immediate and abrupt stop of EMS transactions in Q2. None closed. So announced transactions were pretty good in Q1, which were the lead overs, the ending of the deals that were started in 19. And I think they didn't face COVID situation yet. Then in Q2, nothing closed. Q3, Q4 levels went back to normal. So I think they're on average, it's not the highest trading industry, but we didn't see any slowdown overall, just an abrupt stop in Q1.
Okay.
An interesting, same question, by the way, insolvency. We had an ease in insolvency proceedings in Germany, so we don't have to file. We are typically pretty strict with regard to insolvency rulings. And that has been eased, and we'll see what the outcome of that is going to be, because that's, at least for the last year, the regulations have been lifted not to file for any insolvencies. On the other hand, trading volumes were on average pretty stable too. So there was a drop for those that were very related to automotive business. They just couldn't supply any more automotive industry. Same counts true for the aerospace industry. So they were really in a distressed situation. But most of them somewhat came through because they also, beside the insolvency proceeding rulings, they could take advantage of the subsidy programs, loan programs, etc., issued by the European Union as well as the German government.
Okay.
Interesting. So looking into this year, 2021, we're just over a month into it now. How would you characterize the environment for M&A within the EMS industry moving into 2021? Maybe Tom, circle back to you real quick.
Oh, sure. No, we see it as being very robust. There's just a lot of pent-up demand on behalf of both sellers and buyers. An awful lot of private equity money in the space. And of course, they have a mandate to do deals, and they have both equity and debt financing in place to do deals, and the expertise, of course. One thing we really haven't seen very much, and this is for several years, is much activity on behalf of public companies. And not sure if that's going to continue, but or not. But that's certainly a sector where we just have not seen too much deal activity in North America. And so, if the public companies really, turned on their M&A machines as well, we could see quite a few deals. But I certainly think we're going to see, the same, 25 plus number of deals, but it could certainly be higher this year.
Interesting.
Yeah, I sense there's quite a lot of interest out there. There's quite a lot of people kind of who have kept their powder dry in 2020 because of the crisis, or have kept cash, are seeing what's going to be available, particularly at a good price. There's definitely quite a lot of discussions happening, I think.
Yeah. Jan, how would you characterize it in Europe?
Overall, I think there's the appetites, likewise, private equity, very strong. I could, if restaurants were open, I could have a great dinner every single evening for meeting the origination guys from PE firms because they're desperate for deals. On the other hand, I think they're picking certain sectors. There's a strong shift towards digital deals, lots of software deals that are now being picked up by PE firms who haven't done software ever in their history. So there's a whole change from the traditional manufacturing type PE firms into digital type PE firms and doing service deals, doing digital deals. So I think that is one of the things we do notice. And the other is that in the EMS industry in general, appetite is sort of mixed. Yes, there are some players, private equity firms into that industry, but it's certainly not as strong as it is in other industries because it's capex intensive business, it's low margin business, it's very competitive. If we go to the compare with the global players, which are in a different range. I mean, there are high volumes and low mix. I mean, the German EMS players are different. They're typically low mix, high mix and low volumes. But I've seen very few PE firms really understanding that market and coming up with roll-up strategies, although there are a few which we can maybe cover later.
Yeah. Are those kind of building groups? We've seen quite a few of those deals this year, I think, where companies have had a strategy of bringing together multiple EMS companies and creating groups. Is that something that you're seeing, Jan, in terms of demand? What's the overarching strategy there?
I think that is what we do see. There's one example. There's the former manufacturer of these TVs, which is called Grundig, which is a very long-term established brand in Germany. And that changed totally hands. And now they have their own in-house EMS team, and that was carved out. These type of carve-outs we do notice pretty frequently. To my understanding, One Equity did one too just recently. I think Spartronics was the firm that they acquired and did some add-ons here too. And same as with Grundig Business Services, GBS as they are called. We know that they are hungry to take on others. And we might cover later why it's a little bit of a challenge to buy other firms in that sector. The appetite is certainly there.
Same in the US, Tom, in terms of people bringing together multiple EMS companies to get scale benefits and to potentially build groups?
Yes, absolutely. I think that drives, at least a third to a half of the deals here. That and I was going to mention, out of the 24 or so deals last year in North America, 15 involved private equity,
Right.
And only a couple involved public companies. And I'm really not sure about Europe, but certainly in the U.S., there's a strong tendency amongst customers, especially in that sort of middle, certainly among low volume, high mix, and then, up to medium sized production or so, that they want to be close to their CM. And so, generally within a tank of gas or so, a couple hours drive perhaps. And so, that's driving a lot of the acquirers in the U.S. to expand geographically.
Yeah.
And then of course, so they'll acquire, East Coast, West Coast, North, South. And then of course, in terms of scale, it's so much easier for a larger CM to invest in the latest equipment, the latest systems, training, certifications, and so forth. So that's driving a lot of the acquisitions as well, that there's tremendous economies of scale.
Yeah, so a desire for scale and a desire for proximity. And I don't know whether some of that proximity is driven by a reshoring trend. We certainly see quite a strong trend there in Europe, and that would foster an adjustment in people's footprint, I guess. And acquisition's a good way of correcting the footprint very quickly.
Yes, and I think especially investors, owners who are bullish on the industry, which is a lot of people, have experienced some reshoring and are very bullish on the programs, if of course implemented and actually pursued towards more reshoring, more made in the U.S., especially in critical industries. And even if it's just a small percentage of the amount of goods that are, or especially electronics that are manufactured or purchased in the U.S., if only a small percentage of that comes back in some ways, it would be a huge boost to the industry.
Yeah, absolutely.
Hey, Jan, let me come back to you on something too, and what we're talking about, the deals. What type of EMS are kind of in favor then, building into this? We have both kind of the traditional focused, type, and then you have more diversified service ones with more diversified. And part of that is also the sectors that they serve. How do you see that?
Well, I think the core question boils down to who the buyer is, and we see the difference that some buyers are extremely eager to not go for scale in a sense of size, but scale in a sense of knowledge. So if you add digital capacity to the teams, if you have some engineering specialties, if you have access to certain sectors like medtech and certifications in these areas, so you can build these products. And design and build these products. I think this is where we see an enormous appetite to buy these type of companies. Those that have sort of in the past done sort of a bundle of industries, no real specialties, real manufacturing services, only typically very low margin, they are the ones who are really in trouble in sort of, they're not on the hunting list. Let me put it this way.
Interesting. How do you see that, Tom? How is that in North America?
I'm sorry, could you repeat the question?
Yeah, no, I was asking about kind of the types of EMS that are in favor there,
Yeah, sure. Sure. No, and I'm sorry, I got distracted by a question that came up on the chat.
Yeah, we'll get to that one next.
Well, certainly there are a lot of people who are more focused on military because it's such a huge industry here. Mil-Aero, and then I would say medical is probably the next. And then really anything that, and obviously sort of connectivity, IoT, anything in those sectors. And then of course, things that are sort of out of favor are, more transportation or hospitality or, but it really depends because there's little pockets that are good in just about any sector. And then, I don't think medical is going to go away anytime soon. It's only going to increase. On the military side, you kind of wonder. I think budgets are going to be strong for a little while here, at least. But you always wonder, whether budgets are going to continue to be strong, or there's going to be more of a focus away from products that have a lot of electronic content versus other types of spending in the military sector.
Yeah, different priorities. Should we get to that question that distracted you and get that covered? You saw Dita's question asking about retirees. Basically, is that succession part of, is acquisition part of the succession strategy for some people?
Well, absolutely. That I would say the average age of most owners is of retirement age.
Yeah.
And sure, there's plenty of young blood in the industry, but it's a small percentage. But I think we'll see more of that, and that's certainly driving most of the sellers to want to go to market. And I think that trend is going to continue for a while. And the other part of it is that, and I kind of touched on it earlier, that many of the smaller shops just have not been able to invest in the newest equipment, and especially some of the newest, inspection or other types of equipment that customers are going to demand more and more as they see the larger firms have that equipment.
Yeah, so it's not just the executives and the owners that are getting old.
Yeah, it's all of us.
It's the kid on the factory floor as well. Do you see the same in Europe, Jan?
Well, numbers are speaking for themselves. I mean, if we just take the German numbers, which I know by heart, we have a little more than 500 players in that play. And if we look at 80% are owner managed companies, so they're not any what's PE backed or listed companies. And if you then see the age structure, there's the numbers that we just did. We found out 70% of them are older than 50, 30% older than 60. So there is that entire succession scenario. But then again, that is a true challenge to make that happen, because that is exactly, I mean, my statistical base for one specific example is number is one, but we had a lot of learnings in how to create a succession for that one firm, and that was owner managed, and we can talk about that one. But succession will be a driver. But honestly, I personally also believe that not all will make their succession. I personally believe that if you were to ask me for a guesstimate, I would say a third of them will have to close down at the end of the day, because they will have neither internal nor external succession.
Yeah, not good.
And that's always been a challenge for the EMS industry. I've been in the industry over 20 years. There's too damn many EMS all over the place and a lot of little ones, and that's always a challenge for the EMS. But I'd like to move kind of in the direction of you kind of the nuts and bolts of these deals, not necessarily who they and all that. So, but let's start with kind of a time frame. What is the typical time frame for a transaction? And at what point do you become engaged? At what point should you become engaged? And Jan, let's just follow up with you on that. And
Well, it's indeed a good question, because I think it's never too early to start such a process. The question is certainly what the process is going to be. I think it's planning for a succession or planning for any type of sell of the company. In my former world as an investor, the saying was, after the signing, the exit starts. And that is, frankly, if you tailor your company for an exit, it's never too late. So that's the core principle, I would say. And then I think I could stage it into the three areas. The one is, if you have some long-term perspective, I think 36 months is something that is really good, because then you can adjust a couple of things, like you're in CapEx spendings and investment plans and whatever you do around that one. So it's neither a backlog nor that you have overinvested, and you cannot take advantage of what you've planted on your shop floor. Then there's the second one. Is an average process, anywhere close to 9 to 12, 15 months, including selecting the right partner and running the process, preparing everything. So from the time an advisor is being involved, I would say 9 to 12 months. And then there is the fire sale part, and that can be anything. That can be weeks.
Yeah.
Okay. Tom, how do you see it?
Well, sure. I think in terms of the timing, some deals can happen pretty quickly, in 2 to 3 months if the stars align. And especially when we're working with a buyer who really knows what they want, and they have all their financing in place and everything. Otherwise, on the sell side, typically it is sort of 9 to 12 months. Can be quicker, can of course take longer if something happens either to the business or the economy or something. And then I think in as far as preparing, I do think in other sectors, particularly in tech, say maybe in software or IoT, a lot of companies are founded with the idea to sell. Whereas in electronics, and of course, there's much more CapEx and maybe it's a slower growth sector. But most owners start the companies, and not really thinking about when to sell, and it's way out in the future, 20, 30, 40 years, and their vast preference is to have someone within the family or a close number 2 person to take over. But and we're constantly surprised, and maybe we shouldn't be, but that these owners work so hard to build a business over 20, 30 years or so, and have survived and maybe thrived, and have really spent very little time preparing. And that's the easy work. The hard work is growing the company and keeping it profitable and making investments. The actual preparation is really not that hard, but it is kind of like selecting a cemetery and the kind of headstone. It's something you just put off forever.
Pick early. Yeah.
And really, and it's unfortunate because a lot of owners either leave a fair amount of money on the table, or they end up accepting deals that are, maybe the valuation's not as great, or the terms are not as great, less cash at closing and so on. And it's really a shame.
Yeah. No, you've got to get ahead of that. Just quick question, guys. Are you the percentage of deals that are the seller coming to you and the percentage of deals the buyer coming to you? Which is the strongest buyers? Tom, from your point of view, are you more likely to be acting for a seller or a buyer?
We don't really try to peg it, but it's somewhere around 50-50 for us.
Oh, okay. Jan, same or?
I think we're doing more sell side type projects than buy side. Very selective buy sides, mostly sell side.
Okay, good to know.
I can even give you the number of volume and by size, but it's on average 70% is sell side.
Yeah.
Let's maybe speak to that. What are the common challenges or risks even from both a buy side and a sell side potential for these companies? And Jan, since you gave a brief answer there, let me come back to you, sir.
Well, I think a couple of the core showstoppers that we came across in that business is something very something very easy. It's sort of being sanitized on your inventory. It's sometimes amazing how much inventory EMS companies are running in their balance sheet and showing for whatever reasons, because they need to have a good equity structure or balance structure for their refinancing of their capex. And at the end, that inventory is sometimes very aged. So looking into inventory and aging of inventory, that's a very tactical thing. But it goes up to the very strategic thing, is like who's running the company post-transaction. If the founder and the key driver of the company is also in a C-level position, and there was no room for a strong second-level management to grow behind that person, then that's one of the other key stumbling stones that we're coming across in this business, beside other factors. But I would say those are some very tactical ones and some very strategic ones, because you need to leave room and space for second level management to fill in your footstep.
Yeah, so talent becomes important, the talent that you have in the team. And Tom, I guess that's part of planning for an exit. When you're going to plan for an exit, you got to make sure the business still operates when you do walk out the door.
Well, that's right. Yeah, key person risk is a huge risk or really for both. But buyers are very wary if there's not much of a management team, and then if you don't have a good management team and everything else that you need for a successful business, a lot of buyers will look more at a consolidation type deal, where they buy the business, but they move it into one of their facilities.
Yeah.
Which most owners don't want to see. They want to see it continue, and generally you get a better value if it's acquired as a going concern. Certainly working capital, as Jan talked about, for a lot of owners that working capital is an asset. They consider that to be part of their bank, but buyers see it as more of a weight upon the business, and of course a risk if the inventory is old or customer concentration is a huge issue in the industry. Especially among smaller, but certainly among larger companies too. It's very common to have 25 or 30 or 40% or much higher in their largest customer. And then have the top two be 50% plus. And so for obviously for anybody running a company, that's a huge risk. Two phone calls and there goes 50% of your business. For buyers, they're always worried if there's some transition, old Joe's no longer there, so we're going to shop the business around and see if we can get a better deal. So either a lot of buyers just won't touch it, or the terms, both valuation and the terms of the deal will be not as good.
I was always taught in that respect that the phrase "new team, new deal," right? Everybody as you're speaking to, there's a new team on board. The customers expect the deal to be different. So, well, let me ask though, for small private, companies, and we talked about the aging ones who looking for an equity event in their life now as they're, to retire and ride off. I imagine a lot of these people may have an inflated sense of the value of their enterprise as well. How do you address those issues, or is that common? And if so, how do you address it? And Jan, let me come to you on that one.
I was hoping that Tom takes this one first.
It's the reality check, isn't
it? We can go either way. I'm fine. So,
Tom, whatever you want to go
I'm
ahead.
sorry, I'm getting a call.
No, but
that has to be.
I think you're absolutely right. I think at the end of the day, it's a matter of adjusting the emotional value to the financial value of the company, and I think that is the core challenge. Is something perceived as whatever, nights of no sleep, weekends without family, sorrows, sweat, blood, and whatever was invested into the company over decades, mainly. Always the risk of pledging the house for the next machinery equipment that they are acquiring, and all of these things add up to such a strong emotional value that it's then sometimes it's unfortunately it's sort of a cold shower that we have to walk them through when we tell them how companies are evaluated. That's the first thing we always do is trying to differentiate between those, and then also have to explain between entity value and equity value when they see the high numbers like EBITDA multiples, and then we come to whatever nice valuation, and then there is whatever 20 million valuation and 18 million debt in the balance sheet. So that leaves them with 2 million. And explaining that is sometimes is most extremely hard, and that's one of the core parts which one can sort of optimize and prepare. But if you have to do it fast, then there's not much room to optimize that.
Yeah.
Tough reality check for some people, I guess.
Yeah.
Tom,
what would you add to that?
Yeah, sure. No, that's one of the more difficult conversations we have often, and of course we try to have it up front. Again, on the preparation aspect of it, absolutely the best client, whether buyer or seller, is a well-educated client, and every business has a value, and then but the value changes based on the perspective of the buyer. So, so for sellers, of course, we try to help them either, prepare, try to eliminate whatever risks are possible, shore up whatever, perceived weaknesses there might be in the business, but also try to go out to a wide range of buyers, because, for one guy, there's no value. I wouldn't buy it for $1. And for someone else, they might be willing to pay quite a lot more because you fulfill a specific need for them. But sure, it's tough. Valuations certainly in this industry are not, on the range of big pharma or EVs or any of the areas that are attracting a lot of capital. Although there are a lot of deals, still valuations are not as robust as some of those sectors. And then you introduce them to the valuation to begin with, and then there's the whole concept of cash-free, debt-free, and the working capital is part of the deal. And
Tom,
so
do people come to you having seen like headlines? I mentioned earlier before we were on air, a deal between a 3D printing company and a manufacturing ecosystem play. They're very sexy sectors at the moment. They're getting a huge amount of investment, and the multiple on that deal was huge. So if an EMS guy sees that, he's thinking, that's the multiple I'm going to get for my business. When he comes to see you, Tom, you're going to be the wet fish around the face, aren't you? That's going to rain on his parade.
Yeah, the big cold shower. So, well, there's the public headlines, and then there's the sort of country club headlines. And at the country club, everybody lies. So and then there's the headline valuation, and maybe they are getting the correct numbers either at the country club or from the headlines, but rarely do the terms of the deal actually come out. So you could have a $1 billion deal, but it's 20% up front, and the rest is on contingencies. So that's often, and we of course will give guidance on what we think the company is worth and what kind of terms we'll see. But of course, the key is really preparing and getting out there and talking to a wide variety of potential buyers.
Yeah.
So, you've both have been speaking to the issue here about kind of managing expectations. And so I'd like to kind of shift in that direction, ask kind of about the advice that you would offer to an EMS that's looking to position itself, well, for sale, or, let's focus on the sales side first. That whole transaction readiness. What advice do you offer to companies, without giving away trade secrets here, gentlemen, that you might be doing? But what is that from a transaction readiness? How do you advise clients as you engage with them? And Jan, let me go back to you, sir.
Sure. I mean, we typically, as we know the industry pretty well, I think it's asking a couple of core questions will give us the first insight, or the first insight, excuse me, with regard to their transaction readiness. And then I think it's in the first dialogue will help us to assess that. And I mean, frankly, our business is very entrepreneurial. I mean, we're being paid if we succeed. So within our firm, in order to sign an engagement letter, you have to go through our internal deal board. Sounds super sophisticated, but at the end, it's the partners taking the decision, do we take that entrepreneurial risk of doing the deal or not? And this is sort of our first assessment, because that is how we make money. And if we see that the owner or the seller is interested to work with us, and if we see that there is sufficient room that we can sculpture the deal or come to a deal that is feasible, if there's openness, for example, for the right transaction structure, if their expectations are right with regard to pricing, and frankly, we find that out quickly, because it's a matter of our pricing is linked directly to the value. So all of this will give us the first indications, and then we can help with the company to work with them either long-term or in the process directly. If it's in the process, it's more addressing the pride and sort of showing what the true value of the company is, and maybe putting a little sugar coating on it. But if it's long-term, then we can really be of help. And in one of the companies, we helped them sell off 2 other units before, because we said, this is not something someone is going to acquire. So let's get rid of it. And let's be very focused. So we have a core business which we can sell to a buyer, and not sort of a basket of different areas which for different buyers would be of interest.
That's interesting. Tom, I saw you shaking your head. What would you...
I totally agree. I guess I was thinking about, over the years, I think I've had one client who had a lower evaluation of the business than I did. So it's almost always, at least equal, if not, 3, 4, 5 times higher. But, sometimes we can introduce owners to the magic of EBITDA adjustments, and and of course we don't throw in everything but the kitchen sink, but EBITDA adjustments that we think buyers will accept and maybe argue about a little bit, but generally will accept. And so that, and of course, if they're doing all kinds of crazy stuff with the financials, either we tell them, you got to correct these, or we just can't handle it, like Jan was saying. But sometimes there are more positives in the business than the owners realize. But usually it's a give and take. If they're way too positive and we bring them back, but we say, well, look, we can make these adjustments and make it a little better.
Yeah.
Have you ever worked now with the latest term, the EBITDA, the EBITDA before Corona?
Well, we've had to introduce that concept a couple times, but fortunately, I would say fortunately for most of the companies we're working with on the sell side, and again, this is it's a small percentage, but they actually did pretty well in 2020, and so I would say on that topic that the jury is kind of out on, but again, trying to find the right buyer for every deal. If the buyer really likes the business, I think they'll be more forgiving about overlooking a 2 or 3 or 4 month period, as long as the backlog is climbing and the future prospects look good.
Yeah, I was quite surprised how robust. Quite surprised. I was curious how robust the industry was in 2020. And again, I don't know how much of that is supported by subsidies that will come to an end, but generally it seems to have held up pretty well.
Hey, tell me, what are there maybe some standard operational KPIs that you have your clients, when you engage with them, focus on, or that maybe that you look at it to assess? How is that addressed, Jan?
Well, I mean, standard KPIs, sure. I mean, we do the typical financial balance sheet type KPIs, etc. I think that's one of the things. But then in the EMS industry, certainly it's, for example, it's the foresight with regard to what they have as contractual basis, especially when we're in automotive industry. We try to make assumptions on how long certain series will run and what the average ratios are. So I think that is one of the core dimensions that we look out, because that lends credibility and sustainability to the business. The other thing is certainly is capacity. We're looking into the capacity of the various lines and try to come up with upside potential again. So we're in our industry, we like to talk about the full potential EBITDA. So if someone brings the right clients or has the right or access to sometimes products which were not being able to produce because the company was too small, but if they belong to a bigger group, then they can get hold of larger series. That is something where we can show full potential and where we can look into capacity ratios. And certainly it's aging again of inventory, it's aging of the machinery park, etc.
Mm-hmm. Yeah, inventory is always interesting. I was always taught that just because it resides on the asset side of a balance sheet, it should still be treated as a liability, right, for the issues that you're talking about there. So, Tom, how do you see with the operational KPI, how do you focus your clients?
Oh, sure. Well, all of the above. I think other things we see buyers look at more and more, or sort of what are the potential at those customers. Say, what percentage of spend is the CM getting with those customers, and is there potential to expand it, and then looking at the types of work they're doing for customers. Is it new designs, or is it more legacy? If you look at the boards and they kind of look like they came out of a 1950s TV set, you're like, okay, this is, you're probably not getting a lot of new designs. So and what that looks at. So everything that Jan spoke about before, but those are some that we see some buyers paying more attention to.
Yeah. Listen, we have another question from the audience too. I wanted to ask you. I'm not sure if you gentlemen have seen it, but on the EBITDA, as you said, with the corona, how do you calculate the forward value of any short-term boost a company enjoyed from building, say, respirators? Because it's hard to know how long we continue in this pandemic environment. So, Jan, what's your opinion on that?
That's the unfortunate part, that in some cases we indeed have to adjust it to the negative, and that's indeed something that we have to do. Frankly, we came across more in an area which was related to the short-term salary subsidies that were given by the German government. So your wage levels went down because you received subsidies, or the wages or salaries were being paid to a certain percentage by the German government. And those numbers then have to be readjusted and really to show the true and fair picture of the company, because it's surprising that all of a sudden salaries go down drastically. I mean, they're not the highest expenses in EMS, but of course they're the ones that are quickest adjusted. But that has always been the case. I mean, this is how typically EMS companies adjust in Germany, at least, to fluctuations with regard to demand, is using that short-term payment subsidies.
Yeah, so you're really that dividend that somebody might have received from a, an unusual activity has to be largely discarded in terms of the overall trends in the business. I guess the only differential might be that they've got some benefits from it, and that's allowed them to invest in some more capital equipment, or that's allowed them to actually improve the business. How do you see that, Tom?
Well, sure, and actually, we saw some companies have a boost in April, May, June because their customers were worried that the CMs might be shut down. So there may have been a temporary boost there.
Yeah.
And so, I think in general, if any numbers coming out of 2020 will be met with more scrutiny, whether it's sales or, what the effect of the support, PPP loans and so on was, how people, navigated expenses, because I think most people thought that the year was going to be a disaster. And then for many electronics companies, it really wasn't that bad, or maybe they grew nicely. And so they cut down on expenses. So they're looking all the more better. And, will that trend really continue into 2021 is going to be a question. It's always a question, but I think there's going to be all the more scrutiny for both past performance and future projections.
Yeah, and it's a tough position for the buyer. I mean, put us in the buyer's head. Are the buyers really just looking at the longer term trend and these little short term fluctuations? They like to kind of smooth those out as much as possible when they're looking to calculate value?
Sure. Yeah, they're always worried that a little blip will be temporary, or that the owner was quote unquote window dressing before going to market. So they'll look at it pretty carefully and then make adjustments either to valuation or terms. Maybe put more in an earn-out if they don't feel so strongly about the future projections.
Yeah. And if I may add to that, I think it also depends on the type of buyer. A strategic buyer would take much more of a windshield perspective, forward-looking, try to understand what the future can really bring. Someone who has to leverage the transaction strongly, facing German bank system, which is very backward-minded, will discuss more in length what the history was. Because that's sort of risk adjustment versus opportunity perspective. And I think that is the difference on who you're dealing with.
Well, listen, gentlemen, I'm aware of the time, and we're heading into an hour here, and I'm sure we could keep chatting, but I'm going to resist that temptation and respect your time. But I want to wrap this by thanking you both for taking the time, sharing your expertise and your insights. I think the audience appreciates that. I'd also say to our audience out there that if you're an EMS or a company looking at some M&A activity in your future, you have two gentlemen here, one in Europe, one in North America, who I would encourage you to reach out to. Probably the best ways to do that would be to look them up on LinkedIn and connect with them. And if that doesn't work, get a hold of me, and I will do my best
to down
with them directly. So gentlemen, thank you for this. Hopefully maybe in the future we can revisit this topic with each of you, because I think it's obviously one that'll continue in play and is ever changing here. And we can maybe see at the end of the year if all your predictions for a robust year actually proved out, or if they were underestimated, right? So
true born optimist, M&A guys.
Yes. Has to be. Has to be. So, gentlemen, again, thank you very, very much for your time today, for sharing with our audience. We appreciate you. Continue to stay safe out there, and we'll pick up with you later in the year, I hope. Thank you.
Thanks, Eric.
Thank you for having
Stay
us.
safe, everybody. Bye for now.
Thank you.